All right, let's jump right in. Today, we're digging into the fourth quarter earnings for InnovAge, ticker INNV. They just reported, and believe me, there is a lot to unpack in the results, and maybe more importantly, what they're saying about the year ahead. So first things first, the headline numbers. Look, InnovAge put up a solid quarter, beating what the analysts on Wall Street were expecting. Revenue squeaked by the consensus, coming in at $221.4 million. But the real story here, or at least a big part of it, is on the earnings side. They lost just a penny a share, which is way better than the 2-cent loss everyone was bracing for. So yeah, a clean beat on both the top and bottom lines. But the quarterly beat is only part of the story. The number that really pops off the page is the full-year adjusted EBITDA. It more than doubled, hitting $34.5 million. And get this, that wasn't just a surprise. It actually came in above the high end of what they told investors to expect. This is exactly that turning point, that inflection people have been waiting for. So you're probably asking, how on earth did they do that? And more importantly, can they keep it up? Let's take a look inside their game plan. If you listen to the CEO, Patrick Blair, the message is super clear. We said what we were going to do, and we did it. It's like they laid out a roadmap at their investor day and have just been hitting every single checkpoint along the way. So this quarter wasn't some lucky break. Nope. It was the result of a full year of just grinding it out and getting the business back on solid ground. So what were those checkpoints? Well, a few key things. First, they got super disciplined about costs, just tightening the belt everywhere. They also launched some key strategic partnerships, like the big one with Tampa General Hospital, to drive growth. And maybe the most important piece of the puzzle, they got a clean bill of health on compliance. Now, if you followed this company, you know that's been a huge cloud hanging over them. That cloud is gone. Okay, so that's the past. What about the future? Let's talk guidance for the next fiscal year, because this is really where the rubber meets the road for investors. And the outlook? It looks really, really strong. They're talking about revenue hitting somewhere between $900 and $950 million. But look at that adjusted EBITDA line. That's the main event. $56 to $65 million. I mean, do the math. At the midpoint, that's almost a 75% jump from this year. That is some serious operating leverage starting to show up. Okay, but it's not all sunshine and roses. The path forward does have a couple of bumps, and to their credit, management was super upfront about this on the call. They pointed out 2 specific headaches they're expecting, and they've already baked these into that strong guidance. And this is where things get really interesting from a strategy perspective. First, you've got these Medicaid redeterminations. Basically, they're cleaning house and getting ineligible members off their books faster. Now, that's going to create what they called an air pocket in their growth for the first half of the year. It'll look a little slower. So why do that? Simple. It juices their EBITDA. They're actively choosing to make more money over just showing bigger growth numbers. That's a smart, mature move. The other headwind is this fee 28 payment model. It's more of a minor thing the whole industry's dealing with, so not a huge surprise there. All right, so you've got a great quarter, strong guidance, but also a couple of warnings about short-term speed bumps. How did Wall Street take all that? Well, it was complicated. See, you can't just look at the earnings day in a vacuum. You have to look at the run-up. The stock was on an absolute tear leading up to this report, up 29% in just 1 month. It was crushing the rest of the healthcare sector, so it's safe to say expectations were sky high. And that context explains what happened next. The stock actually jumped another 6% during the trading day, but then the report came out. Once the market had time to digest those headwinds, the stock pulled back a bit in after-hours trading. It was a textbook buy the rumor, sell the news situation, with a little bit of hesitation thrown in because of that nuanced guidance. So that brings us to the big question. The final takeaway, what's our call on the stock? Where does InnovAge go from here? All right, here it is. We're stamping this one with an outperform rating. Why? Because this path to making real money, to profitability, looks totally legit. It feels durable. And that decision management made to focus on profit over just adding more members in the short term, that's the right call. We think over time the market's going to see that and reward them for it. So how might you play this? What's the trade idea? Well, it looks like the market might get hung up on that temporary growth slowdown over the next 6 months. That air pocket could create some weakness in the stock price. And that could be your buying opportunity, because the real story here isn't the next 2 quarters of member growth. It's the full year explosion in EBITDA. As they keep hitting their numbers, the stock should move higher. So what do you watch for? Keep your eyes glued to their quarterly execution and any news on how that Tampa partnership is ramping up.
And we have to end with this, and it's super important. All of this is just our analysis and for your information. This is not financial advice.